this is Judy Ann Scheidler, and I'd like to welcome you back to At Home in Bethel Park. Today we have a mortgage expert with us from Victorian Finance, and his name is Bill Spina. He's been in the business for quite a while, and Bill, why don't you tell me a little bit about yourself?
Well, Judy, thank you for having me, first of all. I'm a licensed mortgage banker with Victorian Finance. My mortgage banking license number is 22871, and my mortgage licensing ID number is 140122. Born and raised in the Pittsburgh area, still reside here. 1983 graduate of Robert Morris University. Honored by being selected 5-star mortgage professional 3 consecutive years in a row, 2010, 2011, 2012. Victorian Finance is a mortgage bank. We're licensed in 11 states, 5 offices in the tri-state area. That includes PA, Ohio, West Virginia. 2 of those offices are in Pittsburgh. We have 1 in Bridgeville, 212 Washington Avenue. Our newly opened office in Murraysville at 3967 William Penn Highway.
Great. And Victorian Finance has been in business for how long?
Since 2002.
2002?
Yes.
Oh, so you're a newer mortgage broker?
Mortgage bank. We
Mortgage
were under the broker realm prior to that, but as a bank, we've been operating since 2000.
So you're a full-service bank?
Not quite. We only do mortgages.
Oh, okay.
That's it. So we process, underwrite, and approve and fund mortgages in our name, and then they are sent off to an investor for servicing, where the client makes their payments.
I think a lot of people don't realize that. That, you know, you go to the mortgage bank or the mortgage broker A, and they finance, they get you all your financing, they get you all your paperwork together, and then they bundle the loans, and then they sell them. So a month or 2 after they settle into their mortgage, they get a letter from another company saying, "Hi, I'm your broker," and they're, or, you know, your mortgage company, and they're a little confused. But this is very common practice.
Well, yes, it is. And what we do at Victorian is everything is done up until the final funding in our name. And the servicing company is set aside at settlement, so the borrowers know who their servicing company is going to be, and they're notified. There's usually at least a 30-day, sometimes a 45-day lag between closing and the first payment. Plenty enough time for that to catch up, for them to get a comfort level with where they're going to be mailing their payments, and if there's any questions at all, myself as the loan officer or whoever the loan officer with Victorian would be the lifeline for them to keep that communication.
Okay. Yeah, I've often heard back from my buyers saying, "Hey, this isn't who I had my mortgage from." So just to touch on that, that's good to know.
It's a constant in the industry, really is.
I know. I've learned that over the years too. Now, let's talk about the mortgage industry moving forward.
Okay.
We have had some issues over the last few years. I don't want to dwell on them, but very briefly, what did we do wrong, and what did we do to fix it, and how are we moving on?
Well, you know, without getting into the politics of it per se, in my point of view, from the loan originator's point of view, since 2008, there's been legislation that's been implemented, from the mortgage originator standpoint, that strictly enforces the Real Estate Standard Procedures Act, which is called RESPA. This was in place prior, but now it's more rigidly enforced. The main aspect as far as the mortgage
Greater oversight? Greater oversight?
Oh, greater oversight,
okay.
Yes. And to emphasize that, from the mortgage originator's standpoint, we are now required to be licensed, It's a stringent process to initially get licensed. You need to pass a criminal background check. You need to provide a satisfactory credit report. You need to pass a stringent continuing education, and also satisfactorily pass a test in relationship to that information. There's a national portion of that as well as a state portion of that. It takes a lot of time for you to get the qualifications in order to apply for your license. Once you meet those qualifications, you apply. The state has their procedures, and then you get your license. And to supplement that as well, once you do get your license, there's an annual renewal that involves continuing education, and again, a satisfactory passing of an exam and supplemental background and credit report. So it's an ongoing accountability from the mortgage originator's standpoint.
And it's, you said federal and state.
Yes.
So we have, and that's why you have to be licensed in different states. Pennsylvania has different regulations than Ohio and West Virginia.
Exactly.
And as you move from state to state, you have to be able to meet all of the requirements of each of the states.
Right. The main set of mandates are set up nationally, and then the state have their individual requirements. So therefore, they're the ones that are charged with actually issuing your license. So, for example, we are licensed in several states. Each loan officer that wants to originate loans in those individual states must be individually licensed in those states in order to originate loans.
So it's the bank and the mortgage loan officer.
Yes.
Okay.
Yes.
So it's double licensing. And has this made a difference? Have you seen an improvement?
Significant. We are more accountable. We have to be. We have to be knowledgeable, updated. The loan officer is now aware of their duties and responsibilities, more compliant of the rules and the regulations, and accountable for their day-to-day activities. So from the borrower standpoint, their lifeline is the loan originator. They will make sure from start to finish that not only are they getting the proper information, but they're getting the best possible program for their needs. And I'm sure we'll get into that a little bit.
And that's because they have a lot more accountability now than they did before.
Yes.
Okay. Okay, so moving, how's the mortgage market this year, by the way?
It's consistent.
Okay.
You know, it is getting better. There's still market value instability. Again, there's more supply than there is demand. And until that starts to level off, then we'll start to see more and more consistency. It's better than previous years. The rates are as good, if not better, than they've been. So hand in hand, it is starting to see positive upgrade.
And the market inventory is very, it fluctuates from one area to the other. It's like some areas have more saturation of middle range homes. Some areas have a more saturation of a lower, under $100,000 homes.
Right.
Does that affect the mortgage market or not really?
Well, in Western Pennsylvania, we've never been too high with the highs or too low with the lows. So we really haven't experienced big market depreciation. So therefore, that's what I meant when I was telling you about the consistency.
Okay.
It's just that the volume levels haven't caught up yet in order to have a big impact to where we need it to be to get our industry moving forward and have a positive impact on the economy as well.
Yeah, the housing industry has to get moving for the economy to get moving.
It works hand in hand, along with employment.
Yeah.
I mean, it really does.
Yeah, what was it? There's varying figures of 8.9, 9.1 unemployment rate, which is still really high.
Yes, and you got to realize that that number doesn't take into consideration those that aren't actively looking for employment any longer because they got fed up. So that number, if they factored those in, it would be increasingly higher.
Yeah. And fortunately here in southwestern Pennsylvania, we haven't had to deal with that as much as in other areas. So we have a few blessings in our area and our market has always been pretty steady. So those are very positives for us. But let's move to the mortgage process.
Okay.
If I'm bringing to you a buyer, the first thing I do is give them your phone number. Now, as a real estate agent, it's my choice not to become personally involved in my buyers' or my sellers' finances unless it's required for some service that I need to provide for them. So as you know, because we've worked together, I will send you a buyer and I know very little about them. So what happens when they call you? Very little about them financially.
Well, after we get the introductions over with and you know, they tell me what the purpose of their call is, basically I prepare them for what's to come. Basically, I need to tell them first of all that we're going to trade some information, some basic information that's going to be put on an application to begin the pre-qualification process. And that information is very, very basic. Name, date of birth, social security number, current housing situation, current job income information. That along with a question to how much they have saved in order to be able to contribute towards the transaction for down payment closing costs.
Okay.
This will play a role down the road after I get the information from them and be able to help me determine, you know, what mortgage product that they would qualify for.
Yeah, there's a lot of different mortgage products. Now, when you do the pre-qualification, how accurate are they?
pretty darn accurate, I'd like to think.
Okay.
You know, at that point, the main piece of information that directs me as to how I'm going to proceed with the borrower is the credit report that I get. Okay, I generate a credit report from a credit repository that we're a member of, and that credit repository generates 3 credit reports on the borrower. The 3 major credit bureaus: Equifax, Experian, and TransUnion.
All 3.
All 3.
Okay.
All 3. And we use
No surprises down the road.
We use a middle score. Okay. We're anticipating the borrower will have 3 scores, one with each of those bureaus, and we use the middle score to qualify. A point I'd like to make with you and the borrowers as they listen to us is that an important part of applying for a major purchase such as a mortgage, it would help to know your credit score. Part of this legislation and this mandate that's been put in the mortgage industry, borrowers, consumers are allowed to have access to 1 free credit report per year. Real simple to get that. The easiest way is to log on to freecreditreport.com, ask the series of questions, and decide how you want your credit report sent to you, electronically, by mail. That'll help when I explain to them the nuances of their credit file. And we can't get into that. That's a subject for another day. It's as individual as the borrower as itself. So, but the main thing about the credit report is it generates the score that places them on a scale based on how they're going to qualify for the mortgage.
Okay. And then what if you get declined? Is there places you refer buyers to for counseling? Is there anything like that available?
I mean, there is credit counseling available. My lifeline to my borrowers, if they require or request me to do so, I request them to go to Pennsylvania Housing Finance Agency. They're out of Harrisburg. They're a mortgage company as well. They do mortgage loans, but they also offer credit counseling based on your locale, your county, and the state. You log on, phfa.org, and click on Credit Counseling Agencies, and you'll get a list of credit counseling agencies in proximity to where you live, and you just make an appointment and go in and tell them what your situation is, and they'll lay out an outline for you to follow.
Okay. And they're free, right?
Yes.
Okay.
Absolutely.
Now, new kids coming onto the market that may not have a lot of credit, telephone, cell phone bills, apartments, even if they're not recorded through a credit agency, do they count?
It's difficult to qualify a borrower that doesn't have any debt that's reporting to the credit reporting agencies. On an individual case-by-case, sometimes we can generate a manual score, but it's very difficult. And then they're limited to what they're going to qualify for. So in lieu of that, I like to help them build credit by giving them some ideas, referring them to a counseling agency, and giving them a short-term or a long-term resolution. And I like to say to them, it's not if you're going to qualify if you follow these guidelines, it's when you'll qualify. And simple things like open up a credit card, consolidating student loans that they haven't started paying on. There's a handful of things, and I discuss those if that circumstance arises.
Okay, good, good. Now, you had talked about the pre-approval. What about filing the mortgage? What else is needed? I mean, W-2s, bank statements?
Once I get this information over the phone and we get a qualified buyer from the credit aspect, because that's the only piece of hard verification that I have in front of me at this point. So therefore, I would call them and I would let them know and what we're anticipating looking at as far as, but I wouldn't be able to, as far as a mortgage program, but I wouldn't be able to give them a dollar amount until they provide me proof of the information that they gave me on the application, which would be the source of their income. That would be verified by either tax returns, W-2s, 1099s, recent pay stubs. That satisfies the income part of it. And then also I would need to see personal bank statements and any asset accounts that would support the verification of the down payment closing cost money that they say they have on hand.
So in other words, don't wait until you decide you're going to buy a house to get together your financial information. Gather it all together, put it in order, get your credit score, then call.
Right. And worst case scenario, if you'd like a quick line of relief, just contact a mortgage professional. And I or they will walk you through these steps and prepare you from that aspect.
Very good. Now, how do you determine the best loan product? Before we get into specifically loan products, what are the criteria that you look at to see which direction you would send any particular buyer?
Well, I mean, realistically, from my aspect, it's pretty simple. I mean, I have everything in front of me about the borrower that's going to kind of paint a picture to me as to what I feel comfortable with and what their best long-term plan would be as far as a mortgage is concerned. You look at credit history, you look at job time, an income to expense ratio, which is simply a percentage of their debt divided by their income. If that threshold is somewhere around the 40% range, then a 30-year fixed rate loan is probably doable. But what type of 30-year fixed rate would determine how much money down, how many assets that they've accumulated, and what their tolerance level of a monthly payment would be. I factor all those in. Then I determine what loan product would best fit them.
Plus the money they have for closing.
Exactly, their assets, right.
Their assets, okay. Now, what are the most common types of mortgage? And tell me a little bit of what's good about them, what's bad about them. Let's start with an FHA, because we do a lot of FHAs around here.
I want to start with FHA. FHA is the most basic type of government-sponsored financing. FHA stands for Federal Housing Administration. Basically, FHA loan allows a borrower to get in with the least amount of down payment for a mortgage product. It's 3.5% of the purchase price. And it also has a little more tolerance with guidelines as far as credit and as far as income are concerned. If there's some supporting factors, a 640 credit score, which is probably on the mid to lower range, would qualify for FHA financing. And as long as they would have the 3.5% of their own funds available to put into the transaction, they qualify. And the icing on the cake, so to speak, with an FHA is they're probably amongst the best rates.
Yeah, okay, so we're looking at good rates with
Absolutely.
low down payment.
Yes.
But the drawback on that would be what?
There's mortgage insurance involved.
Mortgage insurance.
Yes.
And
any time that a borrower puts less than 20% of the purchase price as a down payment into the transaction, mortgage insurance is required, no matter what the loan product.
that's shown as PMI on their escrow account.
Exactly. There's an upfront mortgage insurance premium that's financed into the loan amount that you're carrying into your loan, as well as a monthly with FHA. So for the government to allow them the lower down payment and forgiving some of their credit issues and being a little more flexible with income and that criteria, the borrower is paying for it in the loan. But the net benefit is they're getting a house.
They're getting a house, exactly.
Yes.
And this wasn't on what we talked about, but PMI, that's a little bit deceptive for people. They do not understand that that's not really their insurance, and it's not going to pay for the house if they're not paying for the house. That PMI insurance is designed to cover legal fees, basically?
It's a risk-based insurance, simply because the borrower is not putting the standard amount of 20% down into the transaction to reach that 80% loan-to-value threshold, which has been deemed over time to be a satisfactory threshold to reduce default. The mortgage insurance protects the lender against default. And usually the rule of thumb is first 5 years, 6 years, usually dictates what's going to go on over the life of the loan for that mortgage, barring anything unforeseen, such as a loss of a job or death or something like that.
Okay, so, pretty much if they get through the first 5 years, they're going to be paying the rest of the mortgage off.
Pretty much. That's pretty much, at least the perception anyway.
Okay. And that PMI insurance, so, does not cover the cost of the house. That's kind of what I was getting at. It's just covers
The lender.
The lender for
Default.
Default. Okay.
Exactly.
And okay, well that's PMI is kind of a complicated.
Well, again, I just reiterate: reach out to a mortgage professional such as myself, and I will lay all that out to you, cost-wise, benefit-wise, give you the options, and then we'll make the best decision based on the individual circumstances of the borrower.
Okay, so with FHA we have 3.5% down, and we also can get 6% seller assist, even though some sellers seem to be moving away from providing seller assist. Seller assist is help with your closing costs up to 6% of your loan amount. So you get that on FHA. Now, what about conventional?
It's 3%.
It's 3% on conventional.
Yes.
And how much down on conventional?
You could actually go as low as 5% down. Again, depending on your tolerance for the payment with the mortgage insurance. I mean, that's what you have to look at. And again, it's the risk-based insurance because you're not putting the 20% down. But again, once you get into the conventional products with less than 20% down, the mortgage insurance is a requirement, and also the stricter credit criteria, tighter guideline qualifications. So it's a more of a streamlined.
Is there any kind of trade-off there in the interest rates? I mean, do you get a significantly lower interest rate on a conventional, or not right now?
Actually, no. It's sort of a converse of the FHA. While the FHA is more flexible, less money down, takes into consideration the borrower's total picture, conventional guidelines are very, very strict. If you don't fit cookie cutter into the set guidelines for a conventional loan, credit score, debt to income ratio, down payment, it's going to be very difficult to qualify for a conventional loan above an 80% down payment. And the interest rate, not only are you going to be required for mortgage insurance above an 80% loan to value, but there's also going to be risk-based adjustments to the interest rate based on how far outside that conventional criteria your qualifications fall. So
wow.
you could end up with a much higher interest rate as a result.
So what's the pro for the conventional?
You try to kind of look at the client's options, and more than likely, you can avoid the MI by offering an 80-10-10, which is an 80% first mortgage supplemented with a second mortgage at 10%, which is either a line of credit or a closed-end second mortgage, and it requires a 10% down payment. You'll avoid the MI, but the downside is you'll have a second mortgage payment in conjunction with your principal and interest, taxes, and insurance for the first mortgage. Sometimes that mortgage payment is more expensive than it would be as if you included the MI or the mortgage insurance into your total monthly payment.
Yeah, because that line of credit has a higher interest rate than a mortgage.
It can, again, it's not allowing you to liquidate equity as if you would have just one mortgage. Pay your monthly payments, your principal comes down accordingly. Here, you have two mortgages to pay. Your equity is going to be dependent upon how your payment history goes on both mortgages instead of just the one.
Yeah, that's not something that you see very often anymore, is it?
It's very difficult to qualify for that.
Okay.
So you have to have a select borrower, and normally a borrower will come to the loan officer with that thing in mind, is to avoid the MI insurance with a line of credit or a second mortgage.
Okay. Now, what about a VA?
VA is one of the few no down payment, not no cost loan, but no down payment loan, zero down payment. The prerequisite for a VA or Veterans Administration mortgage is military veteran eligibility.
Not necessarily active duty, just service history.
Yeah, as long as we're able to verify that they have eligibility with a VA, either through active or if they're discharged or Army Reserve or whatever their status may be, they're eligible for a VA loan. A VA has no down payment requirement. It has a 3% funding fee that's financed into the loan. That's the VA charge, but there's no monthly mortgage insurance required with a VA.
There's no monthly insurance.
No monthly mortgage insurance.
Very good, and that's a nice benefit for our veterans. It really is.
It's 100% financing, and you have to look at the payment for the borrower. But yes, if you qualify and you have veteran eligibility, absolutely take advantage of the VA loan.
Okay. One other real quick, do we still have swing mortgages?
Not as prevalent.
Okay.
They were in conjunction with construction loans. And being a realtor, new construction is limited at best right now. The loan products for new construction are limited only because there hasn't been any set guidelines yet to kind of clarify what's needed to qualify for a construction loan. It's in process. There are some things that are being clarified right now, but there's no clear-cut guidelines as far as construction loans. So therefore, swing loans are not in the picture as of yet.
That took a beating on the market whenever people had the loan and the money down on new construction, and the builders went bankrupt. I mean, that was kind of a nightmare, and I did not think that they were really issuing too many swing loans. But again, I guess it depends on your mortgage and your financial income and so forth.
Exactly right. And as you said, look at all the variables that are involved in a construction loan. More things to go wrong.
Yeah.
Higher risk.
More people to depend on. I mean, there's a chain that has to remain in place in order for that swing loan to actually work properly.
Yeah, and the majority of the burden falls on the builder, and you're at their mercy to complete what they promise in order for the funds to be dispersed to complete the project and eventually close and move into the house. So again, it's a risky venture right now the way things are, and just not a popular product.
Okay. Now, maybe just a couple things here to close this up. What are discount points, origination fees, good faith estimates? Just a couple things that people may hear whenever they're applying for a mortgage.
Well, a good faith estimate is simply basically a disclosure, preliminary disclosure by the loan officer to the borrower once a loan program is agreed upon of what that loan is going to cost that borrower.
Okay.
Origination fees are a combination of lender fees that are normally consist of a processing fee, an underwriting fee, and what's called an origination fee, which used to be an application fee, which is no longer allowed to be charged. So those are the three things that, in conjunction, make up the origination fee.
No application fee anymore?
No application fee is permitted to be charged.
Oh, okay. Well, that's interesting. And what about points?
A point...
Is there even an advantage of a point? Our interest rates are so low.
Yeah, I mean, it's all in the perception of the borrower and what threshold they want to get to with a monthly payment. But a point is a true cost, and it adds to those costs to purchase the home. So really, you really need to look at the net benefit of what you're paying for as to what you're getting on the bottom line as far as the monthly payment, whether a discount point to buy the interest rate down is a viable option. Chances are, probably not.
Okay. Yeah. And then, what was today's interest rate, by the way, on an FHA? Trick question.
Let's.
We can go with yesterday's.
If I had to quote an interest rate, I'd have to quote APR. But let's just say we could probably safely say that I could probably get 4 or under on an FHA with a qualified buyer.
That's a sweet loan.
30-year fixed.
Well, yeah, but people have moved away from the ARMs. That's
dangerous.
Dangerous.
Dangerous product.
You're speculating on your future income when you take an ARM, and we found out, unfortunately, that our future income isn't always in our control.
Well, the biggest, if I can interject, the biggest factor with an ARM or any interest-only products is the control of the market value of the property. Somewhere along the line, the market value is going to be tested either by the expiration of the ARM and you're going to have to refinance, or by not liquidating the loan properly by paying interest only. So therefore, the market volatility is the biggest factor when considering those type of loans.
Yeah, and I think that that's a hard lesson that we've learned over the years. Bill, you're very informative, and you know I love listening to you talk, and you educate my buyers every time we write a mortgage deal together, and I do appreciate it. I want you to know that. And I've never had any problems with the loan we've done, and my buyers have always been happy. I'm not saying anything other than the truth. And right now, I'm going to thank you for joining us here at home in Bethel Park, and we will look forward to seeing you next time. Goodbye.
Indoor tanning was safe. They said their tanning rays were less likely to cause a sunburn.
What you need to know is UV light from indoor tanning
can cause premature aging.
And even worse, UV light can increase your risk of skin cancer,
including melanoma.
the deadliest form of skin cancer.
In fact, current estimates are that 1 in 5 Americans develop skin cancer.
One person dies from melanoma about every hour.
I don't want to be one of them.
This message brought to you by the American Academy of Dermatology.